Please do not skip this intro because I have something important to tell you about the structure of how this slideshow will progress. Have you ever been to a sermon or a lecture where they start to go in a direction and you're like, where is this person going with what they're talking about? And then about midway or maybe towards the end, it all starts to come full circle and you realize exactly what they've been saying the whole time. That is exactly how I have planned out this slideshow, so bear with me, because at the end, I have it simplified in a way that all of the information will make sense. It will be in a nice, neat process that everybody can understand. That being said, we're going to start off with a small origin story about where the 3-day cycle came from, the different types of setups that over time have developed off of those 3-day cycles. We're going to explain some general concepts that every trader should really know about breakouts, failed breakouts, etc. And then I'm going to try and make those topics a little bit less confusing with some nice pictures and some drawings to try and start to bring everything full circle. And then finally making it actually all the way around the sun. We're going to make it to where everybody who is watching this video, hopefully by the end, will truly understand what to look for. And then finally, last but not least, what is it? Once it's seen, it can't be unseen. It can be one of the most frustrating sentences on the planet because what is it? Let's talk about that in this video. George Douglas Taylor was an author back in the 1950s. He was a pit trader, and he's the original author of the 3-day cycle. What he would do is he would watch the large money, the hedge funds, people that are trading larger capital, and he started to notice a rhythmic 1, 2, 3 to the markets. He used these rhythmic studies to develop the 3-day cycle. So we're going to go through the different types of days that he identified, and then hopefully you start to see some similarities with your previous studies already about things like first red, first green day. So, buy day. His definition or his talks about the buy day would be after 1 to 5 days of decline, a market that is opened, made a low in the morning, and closed in the upper third of the day's range. On the following day, you might have a sell day, or you should have a sell day where the market has rallied from that buy day high or traded higher, and then you're covering your long positions on that day. A day that trends away from the buy day lows, typically trading higher than the buy day high. If the sell day has a strong close, follow through could occur the following day. I want you to remember that line right there specifically. Then you have a sell short day. Could come immediately following the buy day if the buy day behavior presents in the opposite direction. After the market moves higher for 2 to 3 days, you can expect a sell short day. With the exception of strong breakouts, there might be an additional few days added to the trend. So if you ever notice markets that are breaking out for 4, 5, 6, 7, 8 days in one direction and you're like, man, when is this thing ever going to stop? It's probably because it is breaking out of a larger structural pattern or a classical charting pattern, and it is extending its run because of that breakout. After the market has moved higher for 2 to 3 days, the day will open, make its high in the morning, and close near its low in the lower third of that day's range. That probably sounds like a first red day. Now, I want you to stop. I want you to read through this a few more times and just make sure that you remember the different lines that I have here about the different days, because later on in this video, when I bring everything full circle, this is going to make a lot more sense and hopefully help you to truly understand what you're looking for on any given day. Now, every trader is going to say that the system that they're trading is the best or whatever, but I really do love this system because it fits my personality the best, and it has given me the best results. Therefore, I'm going to stick with what works. And it has objective levels, reoccurring templates. Those reoccurring templates can allow you to scale up in time as your performance dictates. So the more accurate you are, the more you can scale into a specific setup, because that is one that has worked for you in the past multiple times, and it is a high probability opportunity. I really like the fact that I can use hindsight to project what could happen for the day. I'm not talking about every single up-down price movement. I'm talking about what type of day is today going to be based off of what yesterday did and maybe even the day prior. That can set me up for potential setups on the day. And then only have to be at the computer for a couple hours a day. Whereas a lot of other systems, you might need to be at the computer for all day long because you're waiting for that EMA crossover or whatever it may be. Whereas this system is set up so that I only have to be there within my timing window, and if that setup does not present in my timing window, then I don't have a trade, and I can just wait until the next day to see if a new signal presents, or if I have to wait till later in the week. It relies heavily on the clock, the understanding of hourly, 15-minute, 4-hour time rotations, the time when a new bar opens or is about to open. Those times are very important to me about when I should be entering into the market based off the setup that is presenting. And I like it because I can scan through and look at a gathering, a basket of instruments, instead of just having a favorite pair, because if you don't have a trading setup based off of a template on that pair, you're more likely to get chopped up, or you might just have to wait around for an extended period of time for a trading setup to occur. I really wanted to give you all some perspective as well. If you're feeling like you're struggling or anything like that, make sure you read this little bottom part down here. Just a little bit of thought process from my own brain about why traders kind of fail, and the fact that, people like doctors, lawyers, engineers and things, they go through this very extended, very structured schooling, and even when they're done, they still have to go and get some on-the-job training, and they're still going to make mistakes, and being a trader is no different. Just because you've got into this field, or you've got into this area of making money, or maybe losing money at this point, it takes time, and don't feel like you're just going to pick it up in a day or a week or 2 weeks or maybe even a few years. But as you stop strategy hopping and you start really focusing on the things that work, don't be hard on yourself. Please feel free, read through this. Let's get to the next slide. So as previously mentioned, the different work window times, these are all Eastern Standard Time. If you have a problem with knowing what time that is, just Google it. The beginning of the day, so this dotted line over here is going to be a day separator. This is another day separator right here. That first candle that prints to the right is the beginning of the day. The Asian session is from 8 p.m. to 11 p.m. London session is from 2 a.m. to 5 a.m. And the New York session is from 8 a.m. to 11 a.m. Now, in other systems, those times might be slightly different, but these are the ones that I personally use, and it's always worked pretty well for me. Me specifically, I trade the New York session, and I try to find a setup between 9:30 and 10:30 based off my own results. Those are the times where my trades actually seem to work out the best. So between 9:30 and 10:30 is my time. Time of day is everything based on the template. The trade can occur in any session. The important thing is it presenting in your session? So what I'm saying here is that just because I trade the New York session doesn't mean that the trade couldn't have already occurred in, let's say, the Asian or the London session and blown off in a direction. And I'm thinking, okay, well, I'm going to trade the continuation in New York, and only to find out that there is some kind of reversal, or it just goes back into consolidation because I'm trying to chase price coming off of the Asian or London session. So I'm looking for trade setups or templates that has not already started moving in a direction or has not already completed the pattern when the New York session begins, so that I can take advantage of that opportunity. So as I said before, timing the entry is one of the most important parts for any trader. But the understanding of timing rotations is one of the aspects that allows you to get in with as little drawdown as possible right before that trade is about to explode. So that way you can use as much size as safely possible and be able to scale into those trades as they move in your favor. So this is going to talk about that, where the different types of time rotations, the 15-minute bar, the 1 hour, the 4-hour bars, whenever you're at the extremes, and I'm talking about whenever there is a trade setup that is presented. I'm talking about we have a certain type of day the day before, and we're looking at this day now, and we're trying to figure out how to time the trade, where to get in, what are you actually looking for right before you get in. Let's just use a sell example where I'm looking to get in up high within the day's range, or just in general up high, right? So let's say that this is closing price for the day, or from the previous day, right? And the market is traded up. I'm just going to put some random lines up on the screen here. And let's say that this is the high of the day. And let's say that the market has traded back up into the high of the day in some kind of 3-push pattern or some kind of whatever, right? Let's just say that we're at the high of the day now, and it is currently 9:30, and they go vertical through the high of the day. Well, in 30 minutes, a new 1-hour bar is going to open. So if I'm watching down on a lower time frame, whether that's the 1-minute chart, the 5-minute chart, whatever you're comfortable with, and a peak formation starts to get put in place, or if there was already a peak formation in place over here and we've just exceeded that, we might need a new peak formation to be put in place. We're going to talk about peak formations here in a minute. So we can get maybe a 1 candle down, which could be 5 minutes. That could be 15 minutes. If it's 9:30, goes vertical, 1 15-minute bar down. Another 15-minute bar goes back up, and that means that 9:30, 9:45, we're about to open the new hour. Let's say that the new hour opens up at the high, trades up through that on a lower time frame, and then you get an engulfment to the downside. Well, that breakout at the high of the day may have just failed. We have a peak formation in place, and that allows me now to get in at the extreme, at the high of the day, to take that trade back down to the low of the day, or even down to the previous day's low, which is where a lot of these setups are intended to go. So the importance of this is understanding that if we're at the extremes at a new hour and we have a certain type of setup that we are looking for, now we just need to look for certain types of behavior that would allow us to get in on that trade. Now, there's also different types of ways that you can get in, of course. So I have the different situations labeled down here. New hour opens, trader's already trapped, market either explodes up or collapses down. Situation 1 was new hour opens, trades through a previous hour and reverses. And then situation 3. So situation 1 and 2 kind of go hand in hand. But situation 3, market pumps in an already existing down move from an earlier session. New hour opens and collapses, or the equity market opens, 9:30 opens and collapses. Market dumps in an already existing up move from an earlier session. The new hour opens and goes vertical. So for example, if we have the Asian session, London session, let's say that we have a sell high setup based off of first red day, or a sell short day, whatever you would like to call it, and the market has already started to break down. But the previous day's low is all the way down here, right? So if the previous day's low is down here and we're just in a pullback where they've been pumping back up for 30 to 45 minutes or an hour, and then 9:30 opens up high, now we're looking at a trend trade back down through the low of the day and also potentially down through the low of the previous day. And the candle is going to look similar to this. This is going to put in a peak formation high. You're going to notice a stair step of 3 levels, and then a peak formation high gets put in place. They're holding people up high. That equity market opens, or the new hour opens, a new 15-minute bar, and then there's an engulfment to the downside, and that will be my entry every single time to allow me to get in to that trade. I would encourage everybody to go and actually look at their own charts and look at, just specifically, go and find trades where they reversed, or they continued, or they were at the high of the day, or they were at the low of the day, and just mark down what time that reversal started, whether it was before the new hour or just after, or if there was a trend trade like situation 3 that I just showed, what time was that? And that way you just have a good understanding of time rotations. That's the best way, in my opinion, to study them. Now, down here, timing of the trades continued. Let's get that up there so you can see. Oh gosh. All right, so this is situation 1 from the previous slide. Remember, I had it labeled off situation 1, 2, and 3. So situation 1. 9:30 opens up. This is where 9:30 has opened. This was the new hour. 9 o'clock opened. This is where 9:30 opened. And then 9:50 opened right here. So this bar engulfed back down. So if this hour opened right here, and then 10 o'clock opened right here, that would mean that all of this has just became a wick on a 1-hour time frame, which means that traders might be trapped trying to trade long into an extreme. New hour opened up right here, pins up, and then you get the little 1, 2, 3 pattern up and this little breakout pattern to the downside. That is a great place to enter, again, in my opinion. This allows the trade to continue to play out, and again, you can see follow-on movement, breakout, there's the low. It pulls back in a 3 push pattern, goes sideways and consolidates. I didn't put the times up there, but this is, again, a trend trade in that direction. Situation number 2, 7 o'clock's high, 8:30 opened up right here and went vertical through the high. So 8 o'clock opened up on the inside of the previous hour's high. So 8 o'clock would have been somewhere down in here. But at 8:30, they ran the high. So they traded up through it, put in a peak formation. This is not a 4-bar reversal, but up candle, down candle, up candle. So this is like an extended M at the high of the day that breaks down and then trades back up into that high and reverses. So now we have a lower low and we can start to look for that setup. This is not necessarily about entries. It's more just about the timing and the rotations of time. So if 8 o'clock opened up somewhere down over here, that means that at the minimum, right, this is 8 o'clock. We'll say that we'll just be gracious. Real generous with the opening time, right? 9 o'clock opened up here. So that means that all of this is now a wick on the 1 hour chart. And that means that traders may have been forced to buy up high and they could be caught. And you can actually see that visually on the chart. When the market curls and goes back up, they never exceed that level there, which means that traders could be trapped up in that level. And as it continues to break down, that's just follow on confirmation. And then of course, situation 3, right? The market is already in breakout mode. They've already started expanding a range to the downside. And then we start to get our pump up, right? So this is 9 o'clock's open right here. And then they pump back up into that time. And then a new hour opens with a vertical down close candle. So 9 o'clock opens, they trade back up, and then continuation to the downside, or just a trend trade in general. If there was an EMA here, they probably would have been something like this. So they pump back up into the EMA, and then 10 o'clock opens with a line drive straight down. Engulfment that has now trapped all of these people who try to trade this long. And again, same as this example up here where they curl back up and they don't let those people out. You can see the same kind of behavior here where they curl back up, and anybody who is forced to buy up high is now caught. And then there's the continuation to the downside. And here is that same example, the situation 3, except I've put it in the long example where the market is already in breakout mode. They're breaking out. They're making higher highs, higher high in the New York session. That commences the dump back down and the engulfment to the upside. So they've engulfed a structure to the upside at 10 o'clock at a certain time. New hour has opened up and gone vertical, breaking out of a large consolidation. This is not for a trade recommendation, or not even necessarily trade recommendation, but not trying to show you where to get in and things like that. More of just understanding the time rotations, and that these larger moves do tend to come after the 15-minute and the 1 hour rotations, really specifically the 1 hour rotations. And then further explanation of those different situations. Situation 1 and 2, when do you actually use these different kinds of situations? What's their practical application? Trades being executed at or near the, this is supposed to say near the high of the day or the low of the day. That's for situation 1 and 2. Situation 3 is after the market has already traded away from the high of day or the low of the day. Sometimes you'll notice that, like I said, your trade is already in process. The important part is you don't want to chase the price as it is falling or as it is going up, accelerating to the upside. You want to wait for the market to accelerate to the upside and then pull back, and then go back into consolidation. And then that way, that gives you this space, and also because you don't want to get caught in the upper leg of that first breakout. And then down here, in retail terms or in other terms, think about it as like a break and a retest, or a breakout pullback. If you've got an EMA up here, you can do it like that, whatever. But you don't want to chase the price in the direction as it's accelerating. You want to wait for that pullback, and then the new hour opens up. You get a nice little pattern, some kind of short squeeze that engulfs the structure, or it could even engulf the entire structure to the upside, and that might be my opportunity for entry. So situation 3, after the market has already traded away from the high or the low of the day and is in breakout mode, and the clock has confirmed a trend trade. We're going to talk about the previous month, week, and days high and low, because these levels are going to be the main source of your information is going to derive from or come from. So what are some of the benefits? The previous levels are objective. If I were to remove all of the candles from the screen and just have those levels up there, they're not going to go away. The previous day's high and low is not just going to change or disappear or something like that. Those levels are objective, and they give a lot of information about the condition of the market or the trading setups opportunities that you could be looking for on the following day, depending on how price behaved at or around those levels, and of course the open and close from the previous day. These levels are the base of the entire trading system. They identify breakouts, identify failed breakouts, they can identify trapped volume, and they help build a daily and weekly template as the week progresses or as the weeks progress. And the template begins to form. Now, I've got a little, progression here. So I said help build a daily and weekly template. The template begins to form, and then a signal can present based off of those different levels, the previous day's high and low. And then that can potentially lead to a setup depending on what happens on the following day. And we're going to talk about how to filter out good and bad signals, as well as on the day itself when you're watching price move around based off of what has happened today. Is today actually going to present with the setup, or do I need to shift my focus to something else? Down here, I've got some really pretty, just beautiful pictures of the previous day's high, identifying breakouts. And then you can see a day that has broke out and pulled back. You notice that it's closed down low. But this breakout level projected across, it's a breakout pullback in a trending week. Same thing over here where you have a breakout. That breakout has now maybe failed and pumped back up. And again, you get another weak close to the downside, which goes lower. They fall back down on the inside of that breakout level, pump back up, and now we are maybe in a downtrending market. This is all going to make a lot more sense whenever I get through the rest of this slideshow. Failed breakouts. What is the definition of a failed breakout? And I've used this really cool source called Google. A failed breakout, also known as a false breakout, occurs when a security's price moves through a support or resistance level, but then reverses direction. This can happen when the price doesn't have enough momentum to maintain its direction, or when it retraces back down towards the level it just broke through. So in this case, we are looking at the previous day's high and low. This would be our support and resistance. All right, so our support and resistance levels, they break through previous day's high, they break through previous day's low, and then they pull back on the inside of that day's range, and that is what we consider a failed breakout. The importance. Why does this matter? The importance of a failed breakout can identify peak formations at the high of a week, the low of the week, and to begin the 3-day cycle. Can become a first red or a first green day, a signal that could potentially lead to a setup on the following day, depending on the context of the market. Shows where volume is trapped. Where are people stuck? If they have traded the breakout of a previous day's high and the market reverses, anybody who's traded up here at the extreme may now be trapped. So the picture over here to the right, and a little description. The market broke out to the high of the current week and remained in breakout. So this day has closed in breakout on this day. The following day returned into the previous day's range and closed. So this is where the day closed, down over here. A fairly weak close. They closed in the bottom third of the range. This restarts the 3-day cycle from the day the breakout has occurred. Day 1, day 2, and day 3, that trend trade to the downside. First red day, pump up, continuation. Now, sometimes you're going to have ranging markets where the market has maybe gone 2 to 3 weeks of breakouts and gone sideways in a consolidation, or 2 to 3 weeks of breakouts to the downside and gone into consolidation sideways. And sometimes that will really confuse and just irritate people because it keeps on restarting the cycle and they're just whipsawing back and forth and things like that. We're going to talk about how to keep yourself out of silly situations whenever the market does show that it is in a range. So this picture to the right, we had a breakout and a day 1 of the 3-day cycle. Now this was also an outside day where they spiked both sides of the range. This is a very large decline. I want you to remember that. Very large declining day, and an outside day in general that has closed back on the inside of the previous day's range, followed by a vertical day on the next day. Day 1, day 2. Day 2 goes back to the high of the current week and goes right back into consolidation day 3. And you can kind of see the whipsaw action going up and going down. You're thinking, oh, we're going to go up. Oh, you're thinking we're going to go down. Just kidding. So we're going to talk about how to either not trade these at all or understand the conditions of the 3-day cycle whenever you do enter a ranging market and how to trade them specifically. Now let's talk a little bit about signal days. All right, so we have over here, this is a large pumping day. In general, think back to that first couple slides, the part where I talked about tailored trading technique, the buy day, the sell day, the sell short day. A large pumping day, a day that has opened, made its highs in the morning, and made its lows in the afternoon. Traded through previous day's high. They attempted to force that level. They broke out, and that breakout failed and made a low in the afternoon. That is a weak close. This is a first red day signal to be watching the market on the following day. A plus B equals C kind of trade. Not trying to confuse anybody with that. It's just a little bit less confusing maybe than day 1, day 2, day 3 of breakouts, 3-day cycle, all these different things. So if you think of it kind of like a math equation, large pumping day, a day that breaks out and closes at the extremes, bottom third or lower third of the day's range. We also have a peak formation at the high of the week. Whatever. We won't even focus on that. Let's just talk about the fact that we had a large day that broke out, a day that broke out the following day as well and failed at the high of the current week, closing in the lower third of that day's range. And then we're looking for a high of day trade over here. Again, refer back to the entries, new hour portion. Depending on what time of day you trade in the Asian, London, or New York session, there is a trade, high of day trade in the London session and the follow through in the New York session. Now, this day also closed weak. I want you to think about go back to, again, to the Taylor slides. A day that breaks out and has a weak close, what should we expect on the following day? We're either going to see a large amount of follow through, or this day ranged far enough that we could expect a buy day over here. So think back to that. I'm going to explain this better later on. Whew, okay, you're punching air right now and you're like, man, where's this guy going? I promise. Just wait. So let's review real quick. What have we gone over so far? I'm waiting for a template to form. Based off of what the days prior have done, are we in a breakout mode to the upside? Are we in breakout mode to the downside? What day is it as far as the buy day, day one of the cycle, whatever. Are we at the high and low of the week? Like, those are things that you kind of want to ask yourself, but I'm going to simplify that way down here in a few minutes. Template begins with one or more of three things. Either a signal day, which could be a first red or a first green day. Now, this is a first red day, but if you flip this chart over where this peak formation's at the low, that would, of course, be a first green day. You could have a inside day, so a day that has traded completely on the inside of the previous day's range. Basically an inside bar on the daily chart. A failed breakout at either the high or the low of the week. This is going to restart the 3-day cycle. You could have Monday, Tuesday, Wednesday, Thursday, Friday, weekly templates, which I have not discussed yet, but I am going to vastly simplify by the end of this video. I am looking to either enter the market either at the end of or at the beginning of a new hour. Also a 15-minute bar. I am only looking to take trades within my work window. I'm not trading in Asia. I'm not trading in London. Me personally, I trade in New York, so I trade in New York. But if you trade Asia or you trade London, then you are looking for the setup based off the signal to present in your session specifically, or at least I am. If a template has set up, but the trade has already played out in a previous session, I will look elsewhere. I don't want to chase the movement. Now, we're going to take a step back. We're going to start thinking about things in a slightly different way with nice pictures and nice drawings. Now we're going to get into some general concepts, some things that all traders should really already understand, but we're going to go over them anyways, so that way there is nothing left out. All right, so the three things that markets do, this is something that Stacey Burke talks about, and of course, if you ever read some of the earlier works of classical charting, talking about breakouts, large patterns breaking out. Pretty much every trading piece of material out there is going to talk about breakouts, whether that be opening range breakouts, a pattern breakout, whatever it may be. But of course, not all breakouts succeed. A lot of breakouts fail. So specifically within this style of trading, when we talk about failed breakouts and things like that, we're thinking about high and low of the week. So if this is the highest place that the week is traded, and this is the lowest place that the week is traded, and the market trades back up through a previous day's high, this was previously the highest place that the market had traded, we go up, they put in a peak formation, we won't even worry about that, just worry about price went above that level, obviously a breakout, and then now it has traded and closed back down on the inside of that day's range. So there is a way of looking at this and saying, hey, anybody who traded long up here may now be stuck in the market. They could be trapped trying to trade into an extreme, and a lot of times what the market will do is want to trade away from that to, well, blow out everyone's accounts. If I went long up here, let's do as much work possible, or as possible, to blow out those people's accounts and go the other way. Trade away from those people who are stuck. So if a market breaks out of a level, that level may now act as an area of value for a breakout, pullback, and a trend. A market that is in a strong breakout may be in a trend style of week, and it is best to find a 3-day template in line with the original breakout. So if we have, let's say, an opening range, Monday, and we're going to talk about the rules and definition of opening range here in a second. Let's just say that this is Monday's range, and Tuesday breaks out of Monday's range and closes up here. All right, so we broke out of Monday's high, and now we are up high, whatever, all right? But people are probably going to try and sell this because it's at the high of the week, or they're just selling because it's up high in the week's range, or whatever. But it starts to pull back on that Tuesday, or even on that Wednesday, back down to Monday's high, or we could even have a previous week's high up here, where we broke out on Tuesday, and then it starts to pull back and goes into consolidation and then continues to trend, maybe on Wednesday, maybe on Thursday, maybe on Friday. It really doesn't matter. We're going to talk about, of course, some pictures because my blue line examples are not always the best. I know that everyone likes pictures. And of course, trading range. Everything on the inside of a high and a low is consolidation. Therefore, if the market has not broke out yet, there is a chance you are still trading on the inside of a consolidation, and you're more likely to get chopped up in those consolidations. It's best to wait until the market breaks out and starts behaving accordingly. All right, so we're going to come down here and take a look at some different examples of breakout pullback trend. This is Monday's high. Actually, it's funny because this is pretty much exactly what I just did with my silly little blue line example. But Monday, high and a low. This is a consolidation. Tuesday breaks out and pulls back into that breakout level. They make a higher high and then go vertical. So breakout, pull back, and trend. Now we have continued breakout level that is still holding. We've still not gone any lower than that. Again, we've made a higher high now. Again, day 1 of the 3-day cycle. Day 2 of the 3-day cycle, breakout, pullback, trend continuation on day 3, on Friday. Day 1, day 2, and day 3 of the cycle. Now, I understand this is still really confusing because you're going to feel like you're trying to predict price and things like that. Cameron, what's the actual setup? Trust me, I got it. Come on down here. We can take a look at another example of a breakout. Again, they broke out of this level on Monday, so this was Friday's low. And then on Tuesday, they broke out of Monday's low and pulled back on the inside of the range. Now we could project this across. Let's see, is it breakout, pullback, trend continuation, or is it breakout fails and then reverse in the other direction? Well, let's compare and contrast real quick. This breakout level, they were working it. They're jamming up into it, and then all of a sudden it failed, and they ran it back up. Compared to jamming down into that level, going into consolidation and going vertical, working that level, breaking back up to the upside, making a higher high, and then trend trade on Wednesday, vertical back up. So first green day. A day that is opened, made its lows in the morning, and made its high in the afternoon. A day that is considered a buy day when you think about the Taylor trading technique, right? So a buy day followed by a trend day. Now this is the sell day, right? This is where you would be selling or covering your longs from the previous day. And then you can expect a sell short day on the following day if that's the kind of template they're in. Maybe we're in a breakout to the downside sort of template, and you do get that kind of 1, 2, 3 rhythm where you have a buy day, you have a day to go long, you have a day to cover those longs, and then you immediately have the opportunity to go short within the next 1 to 2 days. In this case, that's exactly what has happened. You have a trend day, a day that is opened. They have made their highs in the morning. They have broken down and made the lows in the afternoon and closed. So now we have a first red day, a sell day, and I can look for a sell high opportunity on the following day. And this is actually exactly what I was talking about when I said don't chase price, or I don't like to chase. The trade happened in Asia. Asia broke down. There was a trade in London. They consolidated above previous day's low and then went vertical. But do I want to continue to chase this after it's already gone vertical? Probably not. And this is exactly why right here. Here are some more examples of breaking out and pulling back and trending the market. We had the high of Monday and the high of Friday, of course. This actually broke out of both the high of Friday and the high of Monday and closed on Tuesday. Breakout, pull back, and then the trend continuation on Wednesday. Again, not worrying about setups. Let's just watch and look at the flow of the market. They broke out again on Wednesday. They closed outside the range. Again, pulls back. The breakout level, watch that breakout level. Draw that horizontally across. We're still broken out over here as well. And again, break out, consolidate now in a rectangle, and break down after, of course, 3 days of breakouts as well. We're going to talk about that here in a second. But breakout, pullback trend, breakout, consolidate, and reverse. And of course, this is the breakout level that could fail. And of course, it did. So now we've broken out. Breakout has maybe now failed. And we can go back down to retest the lows. If you've made it this far and it still feels complicated, I know. I told you at the beginning it was developed this way on purpose. I'm going to bring it around. But we're going to talk about the normal market maker cycles now. Again, just help you to visualize the normal price movements within these market maker cycles, because I promise you it is definitely relevant. A normal market maker cycle is going to have a peak formation, low or high, 3 levels of rise or fall, and then a peak formation in the other direction. In a trending market, you might have a peak formation, 3 levels of rise or fall, a peak formation reset, and you can expect 3 more levels of rise. So peak formation low, 3 levels of rise. Peak formation high, 3 levels of drop. That is a normal cycle. In a trending model or a trending cycle, you might have peak formation low and maybe a breakout of a previous week's high or previous week's low. And that has now put the market into breakout mode, where you get these 3 levels up and you're expecting a much larger move down than one of these, right? Where you get a sharp, big, fast move down, and you're shocked when it doesn't do that and it actually goes vertical to the upside. It's because there is a breakout of a level that you probably were not aware of, and it's actually a breakout pullback style of template that goes vertical to the upside. And now you can expect 3 more levels or 3 more days of rise in that direction. In some cases, or a lot of cases, there might be 2 to 3 weeks of rise where they continue going in a direction. Now, when we were talking about entries and looking at the ideal behavior of price at a level, this is going to help explain some of those things. And what are the price patterns that I'm really looking for when I'm about to enter into a trade? The different types of 3 push patterns. Once we get closer to, hey, we're about to take an entry, I just wanted to cover this first because this is a little bit more narrow. But then once we get into the more broad spectrum, it'll be like, okay, well, there's the broad. He already went over the narrow. You just have to go back and review the narrow. Like once you're capable of identifying what kind of day it is, this part becomes a lot more simple. So the 3 push patterns, there's a few different variations. There's lots of different variations, but these are some of the ones that I've noticed are the most common. A 1, 2, 3 stair stepping pattern, the 1, 2, pause 3, 1, pause 2, 3, 1, pause 2, pause 3, be like a burst, a pause candle, a burst candle, a pause candle, and then a burst candle. 3 levels ending in a 1, 2, 3, so like a stair stepping and then ending in a 1, 2, 3, like a combination of these two here. Triple tops, triple bottoms, and also not really a 3 push pattern, but it is a good ideal behavior of price. When you're in the 3rd level of a move, so let's say we have a stair step 1, 2, 3, or 3 days of rise, and you're on that 3rd day, and they start ramping volume up like this, and it goes vertical off of that ramp, and then it immediately starts to collapse. This ramp right here is going to be the fuel to the fire, if you will, for the very fast, strong move back down. This just happened not too long ago on gold and also the indexes. And it actually happens very frequently. And whenever I see this, my mouth starts watering because I just have a part of my playbook, part of my setups is whenever I see this, this is the type of day where I know that I need to be taking this trade, typically with as much size as I can, because it's going to be very fast, very quick, and I can get out of the market within an hour and be done. Now, of course, this is attached to, and all of this is attached to, once I have a setup presenting, I'm looking for these behaviors of price at certain levels, high of day, low of day, high of week, low of week, previous days, high and low, to give me the opportunity. And this is just how I want to see price present at a certain time of day. Over here on the right, you can see a consolidation, and they broke out of that consolidation. Again, the definition of a consolidation is all price movements within a high and a low, regardless of time frame. So I think this was a 5-minute chart or a 15-minute chart. But regardless of that, we had a consolidation between a high and a low that broke out, and we have drive 1, and you can use these little trend line tricks to figure out where the drive ends. You can also use an EMA. The pullbacks on the EMAs help if you can't see it just by looking at how price moves. A couple different ways of viewing it. So in this example here, it's a trend line trick where you've got the trend line, they break it, and then they continue. How do I know that they continued? I know that they continued because they broke the low and they went lower. So this would be like the first push or the first level of drop, and then the second, and then the third, and then there's my peak formation for the reversal back up. Of course, this has to be on a day that I'm expecting a buy trade opportunity based off what the day prior has done. Here's a nice little example of a 3 levels ending in a 1, 2, 3. Steve Mauro called this the 33 trade. I don't know if somebody before him called it that as well. But I really do enjoy seeing these, especially, and I've got this over here, so make sure I'm going to read through this, but in the last leg or the last level of a larger template, I really like to see these. Or even if I have, let's say, a first red day and I'm looking for the sell opportunity, that would be a good example. This is a sell opportunity of a high of day that's in place. They came down, put in a low, and then started pumping it back up from there. And it's just a very clear, clean stair-stepping maneuver back up into the high of the day, high of the current day. And you can see how they've ended the pattern. The breakout, 1, 2, 3 to the high, and then this candle closed down below, so that would be the engulfment of that bar. So this is 3 levels, 1, 2, and then 3, ending in 1, 2, and 3. Over here, I like to see these after 3 days of rise or fall. Yesterday was a signal day, including long or short. such as first red or first green day. So if it was first red or first green day, if yesterday was first red day, this would be good. If I flip this over and yesterday was first green day, this would be good. If I have 3 days of rise or fall and I get this pattern, that could be good, especially if this is 9:30. These are some of the different scenarios where this pattern is useful. Now, sometimes you won't always get the nice 1, 2, 3 at the end, but there will be a nice stair-stepping pattern at times that results in a very fast capitulating or pumping move following, and this is one of those. Again, if I'm looking for a sell high opportunity and I get a pump to the high of the day in a stair-stepping 1, 2, 3, that could be my opportunity. This last bull candle up to the high, think about people who are buying the close of strong bull candles. If I bought this candle here, if I bought this candle here, definitely if I bought that candle here, but I'll just use this one down here. If I bought this candle here, how long before they are now putting me into drawdown? And if I bought anywhere in the upper third of this box, this candle right here, I am now in drawdown and I am stuck. I am trapped. So they could do one of those little curl maneuvers where they come back up, but they don't quite put me into profit enough to get out. I'm stuck, I'm trapped, and then it just continues to do one of those, which I'm sure some of you have felt that before, where you get in and you're like, oh yeah, this is going to be great. And then this starts to happen and you're like, come on, please just let me out at break even, or let me out in general, and then you're trapped, you're done. All right, and I've got this is the exact same words that I used on the previous slide, but again, some other areas where, or the exact same areas where this pattern could be useful. Ramp volume. This is going to come at the end of a large move. So the market may have been traveling in a direction for X amount of days. And then, for example, on this one here, a lot of times I look for this on the third day of breakouts after we have 3 sessions of breakouts. So if we have like Asia, London, and then New York, this is a 5-star opportunity for me that I definitely want to be sizing into when they present, especially around 9:30 and things like that. If this ramp is, climaxed at 9:30, that's perfect timing for me, and I could have taken this trade. I think I remember this day. This happened like at 8 o'clock right on the dot, so I didn't wind up taking this one. But in addition to setups on days where higher or lower price is expected due to a signal, that's where these are going to be useful. And really specifically after 2 to 3 days of breakouts, and you get that third session of rise on that third day of breakouts. Really enjoy seeing this. You can also have this exact same pattern. If I took this and just put it on a different chart on, let's say, a first red day that is broke out strongly to the downside, you could have a breakout to the downside, and then you get this exact same pattern where Asia starts to pump, London does the same, and then New York is trailing higher and higher and higher, and then you get the little peak formation and then a fast move back down to the low of the day, or even beyond. It could break out and keep going lower, but usually these are a good signal for a strong, fast move. And I'm going to leave this up here. I'm not going to read this all word for word, but it is all there for you if you want to pause this and read. To identify these ramps, just notice the way that the candles are moving. Notice how there's really no overlap in the candles. Even the down close is very brief, and then it continues to just pull and pull and pull, and then all of a sudden they just drop the floor out from underneath this thing. And basically all of these people up here that are trying to trade, once again, in the upper third of this day's range are now going to be caught, as well as if they traded the breakout of the high of the day in one candle, they've just caught everybody. So let's project this across. Yep. So if I went long anywhere up here in one candle, they've got me, and they should not come back. And to reiterate that this is not to be traded as its own strategy. This is just defining a behavior of price at a level that you want to see, or that I want to see, in order for me to want to take a trade based off of, again, the signal and the setup. This is a tool that can give you, like I said, a good behavior of price. Can keep you from trading in the wrong direction, having seen the market already make 2 sharp moves to the upside or the downside. Do you really want to be trading in that third level of drop, getting trapped, in that third level down, chasing price, whatever? Helps you to keep you from getting trapped in the third level. Yep, just said that. Help you to manage trades. If you've been in a trade or aren't in profit and you've noticed 2, maybe 3 levels and they go into consolidation, maybe it's time to just close that trade. These stair-stepping patterns can be observed throughout the week as well as the day, and they can help you to identify what kind of weekly or daily template you are currently in. All right, I keep using the word peak formation, but what is a peak formation? Well, we're looking for these at the high and low of the day, current day. We're also looking for these at the high and low of the current week. We could also be looking for these above or below the high and the low of the previous day, preferably at the high and low of the previous or of the week, right? So if we have a previous day's high and that is the highest place that the week is traded thus far, and then we get one of these patterns up here and that breakout fails, think back to the failed breakouts portion of this slideshow. Now we have a peak formation. So let's talk about the different kinds of peak formations. They're essentially double tops, double bottoms, head and shoulders, half Batman pattern, which you can see over here. I know it's a funny name, but it's just, think about the ear, and then the head, and then the nose, and then the collapse. That's a peak formation. Okay. Peak formations are found above or below previous days and weeks, high and low. Peak formations are the beginning of the level count, levels 1, 2, and 3. Peak formations help you to identify what kind of daily or weekly template you're currently in, and peak formations help to identify where traders are trapped, as well as identify peak formation resets in a strongly trending market to help you gauge what kind of day the following day might be. So the different kinds of peak formations are listed down here at the bottom, as well as up here. And for any of these that are, well, I've kind of got them all up there, but you can just flip this over. Short and double bottom becomes a short and double top. You flip this over, extended double top, it would become a extended double bottom. All right, so why is it shortened? Well, it's shortened because this is the lower low, and then this put in a higher low, but that puts in the peak formation. That is engulfed, just like any other classic charting pattern. There's going to be a neckline that they break out of. Think about double bottoms, right? So there's the neckline. Same thing here. There's a neckline here. Same thing here with the micro shortened double bottom. These can be for sometimes a little bit more bar patterns, 4-bar reversals. Sometimes it'll be like a 6-bar reversal or whatever, but essentially down close candle, up close candle, down close candle, and then the engulfment of the neckline of that pattern, right? So down, down, up. There's a little shortened double bottom peak formation. And then the micro extended double top. Why is it extended? Well, it's extended because there was a high, and then they made a higher high, and then engulfed the neckline. So there's a high, a low, slightly higher high, and then the reversal back down. Again, there is the neckline. And then the half Batman, you can flip this over. It would be the same thing, just, facing the other way. Big spike to the high, which a lot of times it's going to be like a two-part pattern, right? That's a triple top or a double top, whatever you want to call it. The peak formation high that was made here, but then the consolidation is what confirmed the rest of the pattern as it rolls over and collapses down. You can see the ear, the head, the nose, and the collapse back down. And I don't have it listed up here, but a head and shoulders would just be right shoulder, and then neckline, and then a inverse head and shoulders is just this flipped over the other way. There's a shoulder, there's a head that exceeds the left shoulder, a right shoulder that does not exceed the head, and then the neckline. Okay. The opening range and initial balance. Let's define them, and then let's put them in a little bit more simple terms, and not really talk about how to use them just yet, but you should already kind of start to be thinking about, oh, Monday creates a box, Tuesday creates a box, the 3 things markets do: buy day, sell day, first red day, first green day. All right, it's all going to tie in. So what is the definition of the opening range? The high and low of a given period after the market opens. I'm sure some of you have probably heard about like the first 15 to 30 minutes after the market opens. Some people use, I think, the first hour or something like that. But for this trading style, we're going to talk about the opening range as Monday. The high and the low of Monday is the first day of the week, so the first trading period within a given period, the week. So that gives us the opening range for the week. Initial balance. Initial balance is a market profile concept which brackets the first 2 periods. So if Tuesday were to make a higher high, that means that they've extended the high of Monday and gave us an initial balance high. Now, sometimes they'll extend both sides of the range and create a bigger box. All right, so if Monday creates a box, a high and a low, Tuesday will usually expand either the high, the low, or both sides of the range. Tuesday could also turn into an inside day. So if Tuesday does not exceed Monday's high or Monday's low, and it just trades on the inside of Monday's high and a low, my high and low, I'm losing my brain one day at a time, that would turn into an inside day, and your opening range initial balance would just be the high and the low of Monday. It is common that either the high and the low of the week will have been formed after Monday and Tuesday have finished trading. One of the side or the other will act as support and resistance. All right, lots of words, really cool. How do I actually use this? I promise we're gonna, in the next few slides, we're almost there. We're almost there. All right, so peak formations, 3 levels of rise and fall, maybe 3 days of breakouts. Peak formation low and a level 1 rise. That puts in a high of day, high of previous day. Coming into the next day, now we have a explosion on level 2 that also puts in a high of day, and then that puts us up into level 3. Now, level 3 really doesn't mean anything unless a peak formation high gets put in place, and you can actually see the little 3 push pattern right there. 1, 2, and 3 to the high that engulfs back down, double top. Peak formation high above previous day's high, closing as a first red day, and then of course the trade the next day. Don't overcomplicate it. If it's not obvious, obviously don't try and sit there and force it. This is very obvious, and it should be when you have these nice stair-stepping 3 levels of rise. And a bonus, of course, if you do have the peak formation high and a first red day, that really gives you a clear signal of what to look for on the following day. All right, let's talk about breakouts. What is the definition of a breakout? When a price leaves a consolidation, it succeeds to move either higher or lower. So if there's a high and a low, a consolidation, and it succeeds to go either higher or lower than that consolidation, and it continues to trend, that is a confirmed breakout. Now, think about what the opening range is. Monday's high and low. Now think about what the previous day high and low is. And think about what the previous week, month, and day high and low is. All right. Previous month, still a consolidation. The previous week is still a consolidation. And of course, the previous day. But if we break out of a previous day's range and it succeeds, we are now in breakout. We have closed outside of that range. So there's really only 2 options. It's either going to pull back and trend tomorrow. I guess there's 3 options. It could just go sideways all day, which is annoying. Or it's going to pump up and reverse. When markets come out of consolidation, there's a potential for a measured move target. This measurement is found by measuring the distance from consolidation high to consolidation low and using equidistant ranges to either the upside or the downside to find a target. So with my little blue line examples, if we have a previous day's high and low and the market breaks out, and then on the next day pulls back, goes into consolidation, and goes vertical for a breakout pullback trend maneuver, we may now be looking at a range expansion of that day's range to the upside. We can measure from here to here and find equidistant maneuvers, so like expansions, right? So let's come down here, and yep, that'll explain it better. Where opening range, we have the high and low of Monday, and then it breaks out of that range, and you can see that I've measured here with the little measuring tool, and it's put down equal distant measurements to the downside for potential targets. Now, this can work for smaller consolidations as well. Let's say that you have entered this trade long for whatever reason, and the market breaks out of this high and low, and you're trying to figure out, where do I want to take profits? You can measure from the high and the low of that rectangle or that consolidation. That's a high, that's a low, that's a consolidation. They break out. Where do I want to take profits? And you can use equal distant measurements to figure out where that measured move may go. You could, take profits here, you take profits here, whatever you'd like to do. But what I have found is that my most conservative time to take profits is going to be that one full expansion. But on strong, really strong days, right, I like to take it here. And if the day is really moving, super aggressive, I like to just leave one up there for a runner. If it does reach there, great. If not, and it starts to reverse before it gets there, I'll just close the trade, somewhere over here. All right, good news. You're still here, which means that you have interest in what I'm talking about. If you could hit the like button real quick, I really do greatly appreciate that. It's going to help this video tremendously. But if you are feeling overwhelmed right now, I know, I've said it like 7 times this video. You're probably like, man, I wish you would really just shut up about it. This slideshow is like 50-something slides long, so I understand that it's a long video. But if you are still feeling overwhelmed right now, it was all part of the plan to just give you the general topics, give you the general understandings, and then now start to break things down to a simple, and I actually mean simple, way of viewing the market so that you can find repeatable setups day in and day out. Let's get into that right now. So some of those repeatable setups are going to be your first green, your first red days, your inside days, your 3 days of breakouts. But there's going to be a lot of times where those first red days, next day they go vertical to the upside and you're like, man, what the heck? Or first green days, they go vertical to the downside, and you might be thinking kind of the same thing. So we're going to talk about what those templates look like, what a perfect template looks like, and then we're going to add in some factors that are not difficult to understand to help you to really capitalize on when the perfect templates show up and be aware of when the poor templates show up because they are actually a breakout pullback template. For example, let's say that this would have came up like this and then broke down like this and then went vertical this day. Man, that would have been really frustrating because, I mean, this is a good first red day template and then it just goes vertical. But there's a lot of things on this day particularly that we can look for to really maximize our accuracy on whether or not that template is going to work out. So let's talk about what these templates look like to begin with. And I've got some nice little simple drawings over here reminding you about the market maker cycles, or the market maker templates. Peak formation low, that nice higher high. That's going to be your first green day in most cases, or in a lot of cases. And then 2 to 3 levels of rise and a peak formation high. Level 3 means really absolutely nothing unless you get that nice clean peak formation high, and preferably a lower low on the inside. So if we have a lower low on the inside, or a lower low in general, after that peak formation high has been made, that might be an anchor point for where the trade could be going in the future. But the peak formation high that was made right here was not the first red day, but that was the Monday opening range. So now we have a high and a low. And then on Tuesday, they gave us the first red day. So it was a day that has pumped extremely far or vertically into the extremes, created a peak formation high, created a lower low, and then gave the first red day where the day is opened. It is traded down and closed below the opening price for that day. Ideally, this could have closed maybe in the lower portion of the range, but that's okay. Not always going to be perfect, but it's still showing weakness, and that we could be reversing back down towards the previous peak formation low. That was the last place that they trapped volume, and that could be where we're heading back to in the longer term. So on the actual trade day, now of course we're looking for a sell high opportunity, and you can see the pin to the low. This is the first mouse, or the person that tried to short too early and then they pump it back up and scare people and do whatever. But it's this coiling down and the explosion down through that low that is the key. All right, now on a smaller time frame, there was opportunities for entry on this, and of course there was follow through and everything, and they eventually did get back down to this low. Now I'm not going to really worry about that too much. I just want to show what an ideal template could or will look like for a first red day. So a good first green day is going to be pretty much the exact opposite. So now we have multiple days, or multiple days of dump, or just one singular very large dumping day. And then we have a day that has traded down through previous day's low, put in that peak formation low. There's that extended W at the low of the current week, and even gave that nice higher high, which you can kind of see over here. And on the following day, now we have a reference for there's a high, there's our low, and then that is our first green day, or maybe even called a buy day, to be looking for a low of day opportunity the following day. So this is a where the day opened here. They traded down through the opening price, or the previous day's close from Friday, and down into the low of the day, and then put in a new peak formation at the low of the day and broke out of that. And that was the beginning of the trade, back up through this high, and eventually doing a range expansion of that day. You could use this high, you could use this low, and measure this, and then you can measure this in that direction, and you'll have a decent reference for where that trade could be going. All right, so reiterating, multiple days of dump, or one singular large day of dump, a day that is opened, made lows in the morning, made highs in the afternoon, ultimately closing above the open for that day, and also preferably making a higher high on that day as well. And then the next day we can look for that trading opportunity. All right, now, of course, there's going to be lots of different ways that price presents this way. It's not always going to look exactly the same every single time as far as the appearance goes, but at least the characteristics, multiple days of dump, 1, 2, 3, 4 days down, a day that put in a peak formation at the low of the current week and closed above the open. That's good. All right. Now, 3 days of breakouts. Again, I've got the nice, oh, my face is in the way. Help, there we go. We got the 3 days of breakouts where peak formation low was made, and then you have a day of breakouts. They broke out of the previous day's high. They closed higher. Same thing on the next day. They closed higher, so that's the next day of rise, second day of rise. Third day of rise, breaking out. So now we have 3 days peak formation low, 3 days of breakouts to the upside. Think back to Taylor. Think back to BTMM when he talks about 3 days of rise and fall. And on that third day of rise, of course, making a lower low. So we had high, lower low, pump up, back up into previous day's high, and then the continuation back down. This is a repeatable trading opportunity. And as long as you're not in a strongly trending market, or honestly, even if you are in a strongly trending market, as long as I get this lower low down, that's what really gives me the confidence to be confirming this trade. So I don't really want to necessarily be trading a 3 days of breakouts unless it breaks down like this, because, well, it could just be in day 4 of breakouts, day 5 of breakouts, day 6 of breakouts. It could be strongly trending to one side or the other. And I don't want to be trying to get in front of a freight train or catch the falling knife or whatever you want to call it. So I really like to see indications of the market breaking down first with this type of setup in order for me to actually take it. Now, once I get this lower low, I wait for the pump up, and then I'm looking to get in on a lower time frame somewhere up here for the follow through, and it should explode down through this low and beyond if it is actually going to behave appropriately. All right, now this is 3 days of breakouts to the downside. You'll notice the almost mirror image, and even though, yeah, the chart doesn't look exactly the same, the characteristics remain the same, where we had peak formation high, and then breakouts, and breakouts, 3 days of breakouts to the downside, a higher high. So now the characteristics are making sense. We have peak formation low. This is a shortened W at the low of the week, and then a higher high breaking out of that peak formation. So this is got this right here. That's the neckline that we talked about earlier. The higher high breakout pullback, and then the little parabolic channel to go vertical. And again, you can measure this consolidation. You could even use these as targets, and ultimately, of course, you can use the previous day's high. If it is a strong reversal back, you can tell this is exploding in one direction. You can use that as a reference because there's money sitting up there. They're going back to stop out anybody that was short in this downtrend, but we're not going to worry about that. Really, just the important parts are understanding the characteristics of the setup, multiple days of dump, a day that has closed preferably in breakout, 3 days of breakouts, and then, of course, went back into consolidation, put in a peak formation low, made a higher high, and that's the beginning of the trade. That is the trigger for me to be watching that pair and watching how price behaves for that trade. Now, of course, this is also, not to try and make this more complicated, but this is where the day opened right here, previous day's close. So if somebody sold the close right here, they just sold into a peak formation low, and now they are trapped. Maybe they have their stops up here or whatever. Something to think about. All right, let's go down to inside days, one of the best signals, but also sometimes one of the most confusing because there's a few characteristics of the inside day that would make you feel like, man, this is 50-50. Do I trade long? Do I trade short? Of course, we're going to cover that. We're going to figure out not necessarily how to choose direction, but of course, behavior of price on the day is going to dictate a lot of things. So with these inside days, the best ones, in my opinion, are two different variations where you get an inside day at the extremes after maybe an extended trend. So you had a large trend like this, and it kind of starts to pull back. Now you got an inside day. Sometimes that inside day will turn into a first red day, and then the next day will capitulate down like this. Or sometimes you'll get the large move like this, and then you'll get the inside day, something like this. And then the next day will go back up, and 3 levels of rise trigger the high of that inside bar. So this is the inside bar. This would be the previous day's high. This would be the previous day's low. So you can imagine if we had an inside day like this that kind of stair-stepped its way like this on the following day up into the high at a certain time of day and put in a peak formation high. Well, if that breakout has now failed, again, thinking back to the 3 things that markets do, if that breakout fails, where are they going to go? Where are they most likely to go? It could be a strong pullback to 50% of the range, but ultimately they're going to go back for the money. In a lot of cases, they're going to go back for the previous day's low. So that is why that is one of my favorite variations to look for of the inside day. But also, when you have an inside bar, once again, inside day is a consolidation, and it's actually going to be a consolidation on the inside of a previous day's range. So ultimately, this is the consolidation, and this is the coil on the inside. So if on the day that we get a breakout, a strongly trending breakout, we could be in week 1 of breakouts, or maybe we got a first green day or something like that. Then we got an inside day that was kind of like a pause day after the inside day. So maybe we have something like this. Then you get your first green day like this, and then the next day you're expecting your trade, and then it's just an inside day, and you're like, oh man, that stinks. And then you kind of forget to watch it the following day. Come to find out that inside day was kind of a pause day. That market goes vertical like this, and then now that can become a range expansion of that entire consolidation, which is somewhat similar to what we see here. Not necessarily the first green day scenario, because this is not necessarily first green day, but this was a peak formation day. And then think back to, again, BTMM, level 1 of rise. As long as this low is not violated, this is still valid. So now we're consolidating in between a high and a low in what could be seen as level 1 of consolidation. And the market is showing signs of acceleration to the upside. Higher highs and higher lows leading to a breakout, and then that breakout obviously succeeds. breakout pullback, continuation. There's that little channel that we know and love, going vertical. And I've got the range expansion tool up there on that inside bar for potential targets. I probably could have dragged this down a little bit further, and that would have dragged it up to about right here, which would have been a more accurate reading. Reason being just because, like I said, the inside day is also a consolidation within a consolidation. So if we break out of the larger consolidation, it has the potential to range further once it actually starts going, right? And to expand upon the inside day consolidation talk or discussion, here's a example where, again, there's the peak formation high. There's that template, 1 day of drop, 2 days of drop, 3 days of drop down. And then we get the inside day consolidating below the breakout of Friday's low. So Monday, Tuesday, that creates the box. Remember, opening range, initial balance. This is our box now. And then on Wednesday, we triggered a low of that inside bar. And you can see the creep down into the low, into that inside bar. There's the consolidation. And then the vertical move back up to and through the previous day's high from Monday. So essentially a low of week reversal back up through the high of the week that's consolidated over the course of 3 days to go vertical back up. This is level 1 down, level 2 down, level 3 down, coming off that peak formation high, inside day, consolidation, higher high. This is the higher high right here, and then the little dump for the vertical move. Now, I think this was a Fed day, so I don't trade the Fed, but regardless of Fed day or not, the templates are going to remain the same. I just don't trade before the Fed, so didn't get that opportunity. All right, let's take a full circle. Let's go all the way back. This is going to be really the climax and the turning point, the true turning point of where the understanding hopefully all comes together for you. And if it doesn't, for all of you that have actually made it this far in the video, feel free to yell at me in the comments and tell me that I'm terrible if you'd like. But this is going to be where hopefully everything starts to make sense. So although they have special names or different names, all of these concepts, they've all came from somewhere. They all originated from somewhere. You can see this stuff in market profile type of teachings. You can see this kind of stuff, obviously, in the 3-day cycle from Taylor. Lots of people over time have taught this stuff in different styles of variations, BTMM, Stacey, Burke trading. Like, all of these people have taught this stuff just slightly different or with their own style of approach, which is very interesting because it's kind of stood the test of time, if you will, just taught a little bit different or maybe used slightly different over time. Oh, we need to get my face out of the way. I'm going to put it right there. Okay, so buy days. Buy days and sell days. Think about some different rules. One of the things that Steve Mauro says is after one large day of drop, the market must basically go back and get the other side. That is not me. I'm probably kind of paraphrasing there. He didn't say that exactly that way. Taylor has a very similar way of saying things where if you could have a trend or something like that, or a higher time frame trend in one large down close day, and that would be like your 3 levels of drop all in one day, and then you can expect a buy day on the following day. Now, this is a very repeatable pattern, very repeatable, and don't take my word for it, go look, where the market is in a trend, and then it has 1 day of decline, and then the following day goes vertical, and that could also turn into a buy day where first green day, now on the following day, we're looking for a follow-on setup. But I like to use these and see these and look for a buying opportunity on the following day, either from previous day's low closing price or just on the breakout back up towards the highs. Whenever it consolidates in a certain manner, we're not going to talk about that too much. Let's just talk about the fact that one large day of decline, you might be able to anticipate a buy day the following day. Does that mean just buy the market? Absolutely not. But what it does mean is you can look for a buy low opportunity the next day if it were to present. And then once you have a buy day confirmation, now you have your first green day style of trading opportunity. And again, you can just look for low of day opportunities, consolidations and higher highs and breakouts and things like that. So let's define what is a strongly trending market. Usually begins after transitioning from breakouts to the low of previous weeks. And we transition now back to breaking out on the other side. So if we have, let's say, a market that is breaking out to the downside, previous week's lows are being broken, they're closing outside of those ranges, and then you get maybe a week of consolidation, or sometimes it won't even give you that week of consolidation. The market will just come down after that second or third week of drop and go vertical, breaking out of previous week's high. The big thing is, did it close in breakout on that week, right? So if Friday closes, we're still in breakout. That could indicate maybe that we are transitioning now back to a strongly uptrending market after a pullback. All right. So let's see here. Obviously, if a market is breaking out to one side or the other, breakouts, 1 week of breakouts, there could be a dump and pump template where they break out, they pull back and continue that trend. It's going to be up to this right here that's going to help me determine whether or not one of those scenarios will be true. Weeks that break out a previous day's high and close with 1 day of pullback, mistaken for a sell short day, first red day, that immediately continues to move up the following day. So this could be just like this, right? Where we have a strong trend, 1 day of pullback, and then a trend continuation on the following day. There's different variations of this where it doesn't necessarily have to be one large down close day. Sometimes it'll just be a very slight variation. So like a down close day where you think, oh man, that's going to be a first red day, but we're still in breakout mode. And the market continues to pull back. Maybe we get another down close day like this, but they're still in breakout mode. And then next thing you know, it's doing something like this, where this 2 to 3 days of pullback actually just turned into a trend trade, which can become very frustrating if you don't know to look for that. All right, so a buy day, aka peak formation day, aka first green day, could be expected after 2 to 3 days of downwards movement. In a strongly trending market, might occur after only 1 day of decline, might be mistaken as a sell short day or a first red day, could be expected after one large down or outside bar. So if you get an outside bar and a trend, the market's going, and then you get a spike and it pulls back up on the inside, there might be a buying opportunity the following day, depending on, of course, where we're at within the weeks of breakouts and things like that. Okay, we're going to continue the discussion on buy days and talking about peak formation days, first green days, things like that, right? So 2 to 3 days of decline. By decline, I'm referring to either breakouts to the downside, but ultimately closing lower than the open. They're making lower lows. And then you have a peak formation day. They've opened the market, they've traded lower, and then they have closed in that upper third above opening price for that day. Does that mean just go and buy the market? No, absolutely not. But coming back to that inside day as well, right? So this could be a pause day. So we have our first green day, and they've dumped it back down into the low, peak formation low, and then gone back into consolidation. So this is our high up here of Monday, our first green day, and then we have basically a rectangle of consolidation on this day right here. You'll notice the higher high and then the pullback, and then of course this is a Fed day, so I think this was that example that I showed you that goes vertical on that third day of the week. After the buy day, then a pause day, inside day, the coil, and then the Fed day, which continues to go vertical. Something kind of important to note or think about is the fact that this buy day, the first green day low, is still intact. There's been no breakout to the downside because that could have reset the cycle. If this was day one and you're like, okay, first green day, and then on day two, the market just consolidated up high and then went vertical to the downside, that could have been a trap in a down moving market. All right, let's go on down here and take a look at some more examples. Buy days, extended decline. This was 8 down close days in a row. Coming into the beginning of a new week, right? So we've got a breakout, another breakout to the downside, and then a consolidation day. So now we have an inside day, and then we still don't have our buy day over here. This is still a lower close. They closed lower than the open. And then on this day, this is where we get our peak formation day, the day that has made not only a higher high, but they made their lows in the morning. They closed in the upper third of the day's range. They also broke out of previous day's high, and they broke out of this nicely wound up rectangle down here, right? So that's our buy day, our first green day. Where's the market going? Well, they've been expanding to the downside for some time, so there's probably lots of money sitting up at these levels, these previous day's high levels. And you can kind of see how this week started or continued to progress. We had a buy day, then we went into consolidation. So maybe this is level 1 consolidation. Low of day, they traded from high of day back down into the low of the day. They made the lows in the morning, and they made their high in the afternoon. So buy the low of the day in an uptrending market, below closing price from the previous day. Good stuff. Now, sell day. A sell day is where you would typically close out your long. So it could be a same day close. For swing traders, maybe you're willing to hold that. Me personally, I don't do that. I only enter the market and close my trades on the same day. But going back and thinking to Taylor's method, sell day, basically the day where everyone's going to take profits. By everybody, I'm talking about institutions and things like that. However, one of the other things that is discussed is look at how the day closes, because if it closes in a strong close, that could indicate further follow through on the next day. So maybe a strong trend, a day that has 1 day of decline, and a strong trend, a breakout market, 1 day of decline, and then follow through on the following day based off of the continuation of that breakout. We closed strong, we had an inside day, now we have an inside day breakout up. Same thing repeats again. Now we're in a trend or a breakout market, a day that is a market that is breaking out to the upside. So now we have another day of breakout, 1 day of decline, getting everybody to try and go short, right? First red day. And next thing you know, market's going vertical to the upside. So something to be aware of. These types of breakout markets, especially when we're coming off an extended decline or an extended incline, once you get these first red days immediately after this long decline, well, it could be a trap. Watch for the trap. Watch the previous day's close, drag that across, drag the previous day's highs across to see, are the breakouts succeeding? Are they failing? This is where this day closed here. Drag that previous day's close across. Who's trapped? Why are they trapped? They're trapped because they tried to sell the close in an up-moving market and they were immediately punished for it. And now this is going to run. And look at this, the rectangle you can measure, stuff like that, all right? Hopefully this is resonating a little bit. I know this is just one example. We're going to continue with more examples right now. I'm going to read this over here. This is an example of 8 days of breakouts to the downside. Finally, Friday gives a buy day, that buy day being peak formation low, close above the open, as well as being a breakout day, which is good. It means that there was a higher high. Monday broke out of the previous week's high, giving the first green day, low of day long in the New York session. So this is the day after we got our first green day. We also broke out of the previous week's high and traded back down into that at the low of the day for the continuation. Good stuff. Remember, in a breakout market, 1 day of decline has a good chance of being a trap. And then just a reminder of what a strongly uptrending market is. I know I keep saying that, or I keep using that phrase, but I want you to understand what a properly strong uptrend market actually means, a market that could be expanding to one side or the other. Go back to slide 40, take a look at that, read the definition. It'll definitely help you. But basically just a market that is just dragging and dragging and dragging in one direction. And for the sake of being thorough and not just rushing through this, I want to go slow so that everybody truly understands what I'm saying. Buy day. What setups came from this week's of trading? A buy day on Friday, which is a signal that could lead to a low of day or low of session trade. On Monday, the market gave that with a low of day, low of session long trade. There's the engulfment to the upside. Next thing, 3 days of higher close or breakouts, peak formation that could lead to a high of day sell. So on Thursday, even though we're in a breakout to the upside market, we do have 3 days of breakouts now, 1, 2, and on that third day of breakouts, the market trades back up into the high of day and engulfs. That could be a counter trend high of day sell targeting the close, the previous day's close, and obviously this went a little bit further. The next setup that came from this was a breakout market confirmed. Thursday still outside of Tuesday's high and previous week's high, trend trade on Friday. So this is just highlighting the fact that we're in a strongly trending market. And then on Friday, this is the trap. You got previous day's close here, which I already have highlighted, and the breakout, the pullback, and then the channel, the continuation back up through previous day's high and the expansion of that week's range. And I've got the expansions up there, basically of Tuesday's high and then the low of Monday, giving you those expansions. Remember, Monday, Tuesday builds a box or a consolidation, and that could lead to a larger expansion for that week, giving you decent targets. Now we're going to do some studies of multiple weeks in a row and just look at them week by week. And I've only chose one pair because we only need one pair. Not that I'm saying you should only trade one pair, but you can still analyze week by week and see these cycles repeating themselves over and over and over again. And once you get really good at identifying the cycles, everything else is just a matter of where should I be taking the trade and what is the behavior of price that I'm looking for, which, if you missed, is at the beginning of this slideshow. All right, so this was on the week of April 15th on the NASDAQ. It looks like Thursday broke out and reversed on Friday, leaving volume trapped at the high of the week. Cool, so we have a a week close, a first red day or a sell short day. They've closed in the bottom third of the box or bottom third of the day. And then they started pumping back up on this day. Look at that, ramp volume into the high of the day and the engulfment back down to the downside, leading to follow through in a breakout of Friday's low. Now, this is a large declining day and a day where we have 1 day of pullback. So the market, for context, is a down moving market because breakout of a large pattern, third week of breakouts to the downside. All right, so we've been breaking out to the downside. We are in decline. We're breaking out to one side of the market, the downside. So that being said, think back to what I said about 1 day of decline could equal a buy day, but in a down moving market, a 1 day of going back up could also indicate a continuation on the following day. All right, so this is a day that you would cover your shorts, but it was a weak close indicating potential follow through. So if you actually just project this across this level here, we can use either this day's close or this one. We'll project that across because they're actually pretty much right next to each other. And I just want you to visualize and picture that anybody who's trying to trade long on this, thinking this is a buy day or thinking that the market is going to reverse based off the decline, maybe they're trying to pick the bottom or whatever. There's a lower low and a pullback and a peak formation to the continuation to the downside, making this easy follow through. Now we have another weak close, so that could indicate again further follow through. We're in a trending market. We have multiple days of breakouts to the downside, but we're declining further, right? We're continuing to make lower lows and lower highs. Don't try and go against the waves of the ocean, if you will. So a weak close could indicate that maybe we're going to have another sell day, so a sell short day. All right, now this one didn't really follow through at good times of the day, so maybe that led to you having to trade later in the day or later in the session. No big deal, because look at that. We got another day of breakouts to the downside. We have no higher high in place. So all they've done is broke out to the downside, following through, put this little pen down here, and then pumped it back up. And there is the order flow once again. It's almost a mirror image of what happened at the beginning of the week has now happened at the end of the week. There's the engulfment, and there is the follow through from the high of the day, from closing price back down to the low of the day and also the low of the previous day, giving us those 5 days of decline, 5 days down, and a new week is about to open up. All right, so now let's go directly to the next week. This was April 15th, or the week of. Now we can go to the week of April 22nd, and this is where that new, after 5 days of decline, we have the day or the week opening, putting in a peak formation at the low of the week. This was also an inside day, but also a first green day. They put in their lows in the morning, and then they put their high in the afternoon, also closing above the open. And then on the following day, you get your first green day, you get your first green day trade, and then you sell basically to cover your longs, all right? So this was a sell day, and then you have a sell short day. Now we might be transitioning back to, because of the multiple days or the large amounts of decline, also the third week of breakouts to the downside, maybe we're transitioning now to a reversal, a little bit of a curve, all right? So 3 to 4 weeks of breakouts, 2 to 3 weeks of breakouts to the downside, and then a first green day. Usually those first green days are going to be a lot more better, if you will, than if I just have a breakout market to the downside and I'm like, oh, look, a first green day. That's usually going to be a trap in a lot of cases. So multiple weeks of breakouts to the downside, ending in multiple days of decline. We get a first green day, then we get our breakout on Tuesday. Again, opening range, initial balance. Remember, initial balance typically expands the range. Okay, so a first green day. Now we've expanded the range on that Tuesday. Now we have a sell short day where they have closed below the open. They put in a peak formation and they have closed below the open or the previous day's close from that day. That's at the high of the week as well. Okay, so now on this day, we're looking for a sell high opportunity. We're making lower lows and lower highs, and there was a sell high opportunity that almost immediately reversed. So if you got the trade here, which I think was at 9 or 9:30, good stuff. You read it. It was a good read. We're making lower lows and lower highs, but then it reversed. So now what happened? This is proof that this could be now going back into a reset or an instance where this was a trap. Our sell short day was a trap, so now maybe we're going to expect 2 to 3 more days of rise. So we have closing with strength, and we've also had a peak formation reset. Drag this across. Opening range high. Peak formation reset in what could now become a trending market. We've also made a higher high. Okay, so some things to be watching out for. I'm going to try and slow this down. A sell short day that reverses strongly on the following day, closing with strength. That could be proof of a trap. We are trapping shorts and then going higher. Some things to think about. Let's go on to the next week. Alrighty then. Okay, so this is that day right here that we just saw where they trapped, or could have been a reset, and we're expecting 2 to 3 more days of rise. All right, so 2 to 3 more days of rise, and we have, once again, low of day. They traded back down into the low of the day, put in a peak formation at the low, and then engulfed and went towards the high. So buy day, sell day, then we're coming into sell short territory, but we don't have our sell short day until this day right here. Okay, project that line across. What happens on the following day? Was there any follow through? Not really. Probably not the best trading behaviors that we would like to see. Well, there was no ramped volume. Yes, there was a lower low. They pumped back up into the high. The engulfment almost immediately reversed. All right, we're out of this trade. It's also not in our timing window. This looks pretty choppy. Let's come back the following day and see, was that a trap? Because that's going to maybe give us a lot of information. Also, I think this was a Fed day. This was a Wednesday. It was a Fed day, so no trading before the Fed anyways. But this big spike up and big spike back down, this is where that day closed. And again, large day of decline in a uptrending market, or potentially uptrending market, that broke structure. They made lower lows, and then they made a higher high. And then on the following day, now we have our buy day. They closed the market with strength, and this is now a reset. Once again, peak formation reset in an already existing uptrending market. Now we have our buy day. So Wednesday, Thursday, Friday, here's our buy day. There's our low of day opportunity for the continuation trend trade back up through the high of the week. All right, so hopefully these resets are making sense. Why is it a reset? We're in an up-moving market. We have one large day of decline and a peak formation at the low of the week, low of the current week, right? Then we get our buy day, which shows strength. That's where the day closed. And then we can look for our trade on the following day. From the low of the day, again, go think back to breakout pullback trend, those slides, right? So now we have a breakout, or a higher high, at least a pullback down to the low of the day, back down to closing price from the previous day, and a trend continuation in the following, or in the upwards direction. Let's go down to the next week. Right? So we'll start back over from where we were last week. So this was that day where we said, hey, that closed with strength. That peak formation reset shows us that the market wants to go up, right? And then we have our buy day, our sell to cover, also closing strong into the close on that Friday. So sell to cover, think back to the Taylor slides. If you have a sell to cover that closes very strong, you still don't have a sell short day. All right, that strong close could indicate follow through on the next day. All right, so we've got our follow through on the next day. Still no sell short opportunity, and we're continuing to make higher highs and higher lows. Now let's count the days of breakouts real quick. We've got 1 day of breakouts, 2 days of breakouts, 3 days of breakouts, and a peak formation at the high of the week. They close back down underneath. All right. Not necessarily a 1 day of decline just yet. Spikes back down into the low, sell short. Remember, 1 day of decline in a strong trend could indicate a buy day. All right. And then that gives us, once again, a Wednesday, Thursday, Friday. There's our buy day. 1 day of decline. Notice they closed under the open. Closing with strength once again and ripping up. All right. Now, of course, we're at the high of the week on that Friday after 1, 2. This day didn't close as a breakout day, no big deal. But the third day of breakouts at the high of the week, high of day trade, back down to, once again, closing price. In an up-moving market, closing price is the target. Sometimes it will follow through and go further. But yeah, hopefully everyone's following along with where I'm getting at with this. Hopefully it's making sense. Let's go down to the next week, right? So this is where that ended. This was that high of day trade. High of day, sell back down to closing price. Let's see, how did this day close? They closed in breakout. All right, so we sold to cover, but we don't necessarily have, there's a high of day trade, of course, but excuse me. Now, on the next day, you have the inside day. All right, so now we're waiting. We're again waiting for more presentation. Inside day, is it going to reverse or is it going to turn into a breakout? Opening range, initial balance. Initial balance has expanded the range. Also, in an up-moving market, we have triggered the low of that inside bar and traded back up to the high of the inside bar. Cool. And it also closed as a breakout, closing in the upper third of the box. So maybe we got a reset over here somewhere. All right, same exact price maneuver. Look at this. Breakout, pullback, continuation. Where was the other one? This one right here. breakout, pullback, continuation. And then this one right here, breakout, pullback, and then the continuation. Monday, Tuesday, Wednesday. So breakout, pullback, continuation on Monday. Or Wednesday, excuse me. Strong close. Keep thinking about those days of breakouts. Also, think about how many weeks of breakouts do we have now to the upside? How long have we been going higher? All right, so we've got 1 day of breakouts, 2 days of breakouts, 3 days of breakouts now on the NASDAQ. And this was a sell short day. Also a sell the high of day after 3 days of breakouts. And I think that might have been in the afternoon session. All right, well, now we have the potential for two things. This is either going to once again turn into 1 day of decline and a reset, or this was going to be a good first red day trade down. Okay, so obviously not the best first red day trade. Maybe we scalp some pips on there. Cool. However, if we wait and we're patient, you can see now, this is now May 20th. It did turn into a reset. Following that, we get a buy day, and we get the same exact behavior once again. Below closing price, low of day, engulfment, continuation back up, and a strong close. Now, of course, starting to weaken a little bit, and we're probably in the third, oh, there we go, 4 weeks of breakouts. So we're into the fourth week now of breakouts. We have 1 day of breakouts, 2 days of breakouts, 3 days of breakouts to the upside in that third or fourth week, and a high of day sell. Breaks down, lower low, pulls back, and the continuation. Now, this was a very large decline in a up moving market. I wonder if that's going to be a buy day for the following day. Oh, there it is. Yes, it was. Okay, peak formation, low, breaks out. There's the channel and the follow through up. So that could be part of your playbook, part of your trading setups that you're looking for. Okay, now remember the context of what has happened. We have 3 to 4 weeks of breakouts to the upside. We had that reset or reversal, but we're in the third or fourth week of breakouts. We also have an inside buy day. So the trend trade back up has now tapped into the high of that inside day. All right, we've tapped into it once. We've tapped into it twice. They closed in breakout. And then now we get finally a sell short day after 3 to 4 weeks of breakouts to the upside in a market that is now breaking down, closing in breakout to the downside, sell short day, looking for high of day sells. So now we have a lower low. They pump it back up to previous day's high, closing price, peak formation, back down to and through the low of the day. A very weak close, a consolidation, and everybody trying to pick the bottom once again. And they trade back up to, again, closing price, high of day sell, right up there, and right back down. There's the engulfment and the continuation down through the low. And we're on to the next week. So we had that capitulation, V-bottom reversal, peak formation, that was made on Friday. Now we have the high of Friday. All right. No higher high in place yet until Monday. Monday's the opening range, and the process repeats. Now we have Monday's opening range making that higher high, but no buy day, no sell day in place. Really unchanged as far as the look at this close here, look at this close here. We're just kind of trading sideways at this point. Right up until we get our buy day. Peak formation low. There's previous week's low. I've got that annotated because we broke through it. And now we are resetting on top of that by putting that peak formation in place. And also closing, not necessarily as a breakout day, but above the open. All right, so we get our buy day. And then we have our trend day on the following day. We're selling to cover. We have a strong close that would indicate or could indicate follow through either on the next day or maybe 2 days after. And we have 1 day of decline in what we believe to be an up moving market based off of opening range breakout, peak formation reset at previous week's low. We're in breakout mode. We have a strong close, 1 day of pullback, and then once again, low of day buying opportunity from low of day back to high of day, and also high of week. Now, I think this is gold, but I'm kind of a goofball, and I didn't put the name up there of what pair this was, so yeehaw for me. However, hopefully you are really starting to see the rhythm, all right? The rhythm of the market maneuvers and the types of days, the types of closes that occur within the week, the opening range initial balance and things like that. All right, so let's take a look at this. The beginning of this week was a peak formation at the low, day 1 3-day cycle, also a buy day. They closed in the upper third, peak formation at the low of the current week. Look, there's that inside day. You got your pause day. The low of the buy day is still intact. That's good. And then on the following day, the higher high in a consolidation down low and the vertical breakout to the upside that goes back up through previous day's high of that inside bar and also closes once again as a strong day, indicating that there could be follow through, even though this is the rhythm, right? Buy day, sell day, sell to cover. But with those strong closes, could be indicating follow through the next day. We get a breakout at the beginning of the day, a pullback, a consolidation on top of the previous day's high, and a vertical move back through the high of the day. And of course, now we're into the third day of breakouts. Day 1 of breakouts, day 2 of breakouts, and then on the third day of breakouts, they make the lower low down, then they come back up and hit the high and engulf to the downside, go sideways, and of course this is in the London session, breaking out back down towards the downside, and I think this was like 800 or 900 pips of decline. Okay, so after a large decline, we might be able to anticipate a buy day. What do we need to look for? Peak formation down low and the close. People are trapped on the close. If you try to sell this close, you want to see people caught on the close. So now we have a consolidation down low and a breakout. Once again, there's the little coil and the continuation back up. Now we have a buy day. We have a buy day. What does that mean? First green day. This is a Monday. I'm looking for a buy low opportunity. Market immediately dumps down, creates a low, trades back into the low, creates a higher high, and then there is our little channel going vertical back up through the previous day's high. And it also had a strong close. So even though this is a buy day, a day that we want to cover our longs, and then looking for follow through on the following day. Why? Because of the breakout and the strong close, right? We're closed in the upper third of the day's range. And there we go again. All right. Hopefully you all are starting to see the rhythm. If you're understanding large day of decline, look for a buy day, large day of, incline or whatever in a down moving day or a down moving market. If we're in second or third week of breakouts and we get a huge up moving day, kind of look for that reversal on the next day. But overall, it's very simple rules. Very simple rules, and I've just explained it. If you want to really truly understand, just listen to all of these case studies. Listen, you could put it in 0.25 or 0.5 or 0.75 playback speed, but this really explains what to look for on any given day. Let's go down to the summary and talk about what we've talked about thus far. So thus far in this video, you do not need to trade every single day. Now, I've kind of just explained like what you could be looking for every single day, but does that mean that it's going to present price perfectly every single day? No, of course not. But once you start to see the templates repeating over and over again, you're going to know kind of which ones you like to see, and that will give you a better playbook of what to look for. All right, so in strongly trending markets to the upside, buy day, low of session, low of day trade, and then you're going to wait, depending on how the day closes, for maybe some follow through on the next day, or maybe just wait for a new template to set up or look for a different template on a different pair. Large range, down close day or outside day, you can look for low of day, low of session, closing price sort of trades. Anticipate that day to also become a buy day, which will lead to a low of day or a low of session trade. 3 to 4 weeks of breakouts, ending in 3 days of breakouts, you can look for a high of day, high of session reversal. Breakout week 1, so you have a breakout week, 1 down close day. So if you have a breakout to the upside and then you have 1 down close day, that could lead to a first red day trap, which will also lead to a low of session, low of day presentation of price for you to get that buy trade in the upwards direction, which could also turn into a buy day. If that happens, that leads you into the next day, turning into a low of day, low of session trend trade, showing that shorts are trapped now in that reset. Strong trending to the downside, everything from above, but in reverse. All right, everything I just said up here, but you're strongly trending or trending to the downside. Remember the definition of the breakouts and things. So what does this translate to? All right, some of you may have heard first red, first green day. Some of you may be brand new to this, and you're just like, man, whatever. Go back, rewatch this video 4 times. Go back, rewatch it 4 times, and then go and find these exact same templates on the charts. Pull up the slideshow and try to find exactly what I'm talking about, because once you see it, you can't unsee it. 3 days of breakouts, inside day, peak formations, 3 levels of rise and fall is more of a concept and an understanding, but 2 to 3 days of rise or fall, 2 to 3 weeks of rise or fall. Weekly template setups, Monday, Tuesday, Wednesday, Thursday, Friday, the 3-day cycle. Everything that we just went over in those case studies, where I'm hoping that it simplified everything quite extensively. This is exactly what this translates to. So hopefully that makes it a little bit more clear. Once you see it, you can't unsee it. What in the world is it? My opinion of that is that this is it. All right, the rhythmic 1, 2, 3s of the market. The rhythmic, we're in an uptrend, but it's pulled back one day. Oh no, what do? It's got you guessing in all different directions. You're trying to trade direction, but once you understand these templates, everything comes into light. Everything becomes so much more clear. So that way nothing surprises you anymore. You feel fully prepared for each day of what to look for. And if that doesn't present because you're just flat out wrong, or maybe you've missed something, hey, so be it. But hopefully this video has helped. Hopefully it's helped simplify things for you. Hopefully the explanations were good enough to get you in the right direction. And if they have, ladies and gentlemen, please do me a huge favor. Hit the like button, subscribe if you have not subscribed already to this channel, because I will have lots more content, of course, coming. It is what it is. Hey, but I'm going to go over ranging markets, what to do in a ranging market. That is going to be my next video. So hopefully that gives you all something to look forward to. I hope you have a great weekend, and I will see you in the next one. Bye-bye.